There is a high degree of risk in trading. If you've traded for more than one day, you know that you can and will lose money. Only trade with money you can afford to lose. Well, thank you for joining me, everyone. Art Collins here. I want to talk to you about a rather unique day trading system that I've developed. The third system, how to profit by trading off 135-minute bars. About me briefly first. I'm a 29-year member of the Chicago Board of Trade. I was a mechanical system developer, trader. When I went down to the exchange, got my membership. I was hoping to augment my approach with pit trading techniques. But as is almost always the case when you're trying to combine some discretion with a mechanical approach, you tend to get the worst of both worlds. You have to be a reactor to trade in the pits. I'm not. I'm a proactor. Everything that I do is set up and execution, and that's what I have to settle for. It's not a perfect world. Got to endure drawdowns, etc., but it's a winning world. It's a path to profitability, which will put you in rarefied air versus most traders. Most traders lose. About 15 years ago, I decided an additional income stream that wasn't quite so chaotic would be nice. So I ventured into the public side of trading, lectured extensively across the country and beyond, and I've done innumerable presentations like the one you're watching now. Wrote for all the major trading publications, and I've authored 4 books on trading. You're seeing the most recent one in front of you, Beating the Financial Futures Market. It was published in 2006. The rights have recently reverted to me. There was considerable demand while the book was out of print to get it up and going again. I've succeeded in doing that, and I've also been very gratified that a lot of the personal turnkey systems that I put in that book have held up over the last 11 years since publication. So I invite you to check that book out on Amazon or my website, artcollinstrading.com. Now, what is it about the third system? What do I mean by thirds? Why did I develop it? Etc. I'm constantly in the research lab looking at show-me studies, scrolling through charts, and my mind just, I allow it to go everywhere. And the more unique an idea is, the more I like it, because you've all heard the adage, you don't want to be doing what the crowd is doing. You don't want to go for the herd mentality because the majority loses. So while, you know, the 5-minute bar is the standard for intraday trading, for day trading, and I use it probably in the majority of what I do, I'm also considering alternatives. And one of the alternatives was, what if you divide the daily 405-minute session in the mini index markets, the S&P, Dow, Russell, Mid-Cap, and NASDAQ? What if you took that 405-minute day and divided it by 3? Why? Well, why not? but also, you know, this came out of the observation that any seasoned trader has, that trades that occur early in the day do have a different characteristic than ones that trade later in the day. So it just stands to reason that if you could break the day into thirds and treat it like sort of mini daily bars, you might find something. So that was the idea of that. Break the day into 3 equal parts, ending at 10:45 a.m., 1 o'clock p.m., and 3:15 p.m. Central Time, respectively. make a day trading system out of it, out by the close. And what I came up with works in all 5 of the major stock-related mini futures contracts. Will signal up to 2 times per day in all 5 futures contracts. Signals are generated at the close of the previous day. That'll give you this morning's opening price, opening trade at the 8:30 opening. And you may be holding that trade through the day, or you may be reversing it at 1 o'clock. The way the signals are determined is by the direction of the open to close of the 3 bars leading into the time you're at. So I like the elegant symmetry. All right. 3 daily bars, 3 bars leading into it. Thirds. You can't collapse a triangle. I may get a little artsy here. Holy Trinity. A lot of uses for thirds. It's going to work out. We're going to take a look at that. When you get in at 8:30, and that is determined by the open closes of yesterday. Let's pretend that we're at 8:30 in the morning. You'll look at the direction of the open close of the 8:30 to 10:45 bar, the 10:45 to 1 o'clock bar, the 1 o'clock to the 3:15 closing bar, where the open to closes in each, up or down. So you're going to get a series of plus, 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 minus, plus, minus, plus, etc., etc. And I just looked in the research of what does each given combination portend in the way of would you rather be long or short. So almost every day you're going to get an entry signal for the start of the day, barring the rare occasion where a number is exactly tied. So you enter long or short. Now, I'm going to show you, the results on this. I want you to understand that I'm not handing you a gold bar holy grail system that you would likely want to trade as is. As is always the case, I'm getting you started on something. I'm giving you a bare bones concept. I'm not showing you stops. I'm not showing you any refinements. That's up to you. If you're a serious trader, you're going to want to, get in there in your own lab and tool around with this thing. But it is a very pronounced bias, and I think that's the kind of knowledge that's always worth having. Just understand, it's not my business to, hand you a money machine for free. If you believe that, then you're just maybe not a serious trader. All right, so you're going to either hold the trade throughout the day. Again, in reality, that's hard to do. That's up to you to work around that. Or you're going to reverse at 1 o'clock and then hold that into the close. In either case, you're going to exit on the close. No overnight positions. So it's possible to have only one trade, as I mentioned, or 2 trades. And this is what that approach yielded from the beginning of 2005 through the end of 2016. Each trade is penalized $5, so these average trades that you see is over and above that. Net profit speaks for itself. Got some reasonable ones here and one very good one. I should mention that I was working primarily in the Russell. That's probably the market I personally trade the most. So think of this as a Russell approach that I developed that is confirmed in the other markets, and that's important to me. Anything that I develop that I want to trade in a given market, the related markets have to be confirming the bias to one degree or another, and you see here that they all do. Only the mid cap is very close to break even, but at least it's not contradicting. Okay, so the net profits speak for themselves. You certainly can't argue that this is fluky given the vast amount of trades. You know, again, you're in every day, sometimes twice. Percent profit, it's near 50. That's fine with me. That's one of the big misconceptions that I've noticed traders tend to have, judging from the questions I get in lectures. They ask, what percent profit do I shoot for? Meaning, you know, it's important to have a system that works almost all the time. Well, that's a nice pipe dream, okay? But it's not possible, A, and B, it's not necessary either. We're trading a numbers game. We're not worried about any individual trade in progress. That's the domain of the discretionary trader, you know? They're always massaging the trade that's ongoing. Do I take a profit here? Can I squeeze a little bit more out of it? Where do I cry uncle, etc.? A numbers game is just looking at the totality of all the wins and losses put into a big hopper. And if you have a robust bias, that likely will take you into the present and future, that's all you worry about. If you were looking at a pure momentum system, the average pure momentum system, buying X day highs, selling X day lows, for example, tend to only yield 30 to 40% profits. So what do I shoot for? I don't. Do I admit to being happier when I'm rewarded more often rather than less? Yeah, psychologically speaking, I am a human being. I'll admit to that, but it's really not a key consideration in my testing. Drawdowns, this is, you know, where I have to re-emphasize, I'm not advocating that this is a system that you can run out and trade as is. 25,000 is more than just about anybody would care to trade on a single mini contract. Again, this was primarily to be a Russell. We're kind of close there. $13,000 off a profit of $94,000. Almost doable, and the average trade is certainly good. This is the real key figure, though. All right, this is ROA, or return on account. What that is the net profit divided by your worst drawdown. Why is that an important figure? Because it tells you what your account would have increased had you started up with the worst drawdown amount. So in the Russell case, you bring $13,515 to the table. You're unlucky enough to have your worst string right in front of you, but you weather it and go on to make $94,445 in this time period. That is an increase of your original stake of 698%, almost 700%. So why is that significant? Well, if you were only testing according to net profit, okay, and you had a system that showed a $100,000 profit with an $80,000 drawdown versus one that made $40,000 with a $8,000 drawdown, which is better? If you were testing for net profit, you might be fooled into thinking a $100,000 system, right? $20,000 better, but it's vastly inferior. Why? Could have traded 3 contracts on system B. Done better on both ends, made more money, 120,000 versus 100, far less risk, total of $24,000 worse drawdown versus 80. So I test for return on account because it gives you your expectations in relative terms. All right, so again, the methodology of this is you're simply eyeballing what the last 3 open to closes did. So if it's early morning and you're about to trade this on the opening, you're basing it off the 3 bars of the previous day. What did the open to closes do? Obviously, you can eyeball that very easily without needing TradeStation or any other platform. You would be a buyer at the 8:30 opening. I'm getting ahead of myself a little bit. Let me just say that the open to close, we will give it a +1 value if it's higher, and if the open to close is lower, we'll give it a -1 value. All right, now for the longs at 8:30, again, you're looking back at yesterday's three 135-minute bars. From the furthest back to the most recent, you would be a buyer if you saw 3 lower open to closes. You would be a buyer if it was plus, minus, minus. Again, that plus is the 8:30 to 10:45 bar, followed by the 10:45 to 1 o'clock and the 1 o'clock to 3:15. You'd be a buyer if it were plus, plus, minus. You'd be a buyer if it were minus, plus, minus. Your short sells are mirror image opposites, which is the case in virtually every system I come up with. I do not want to stack it more to the long side or the short side. That's a good way to over-optimize, okay? You'd obviously have better results in the stock-related futures if you were making it long side friendly, because the market has been doing pretty much a 45-degree angle from the lower left side of your screen to the top right corner pretty much forever, barring some harrowing counter moves. Well, I don't want to bet on that lasting forever, okay? And my theory is if something is good to the long side, it should be equally good to the short. I won't do it any other way. So, short side, plus, 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 minus, plus, plus, minus, minus, plus, plus, minus, plus. Now, little side anecdote here. I actually thought I was coming up with something that would give me signals for all 3 bars, including the middle bar. And for a while, I was fooled because the buy-short signals that were being spit out on the middle bar did not look exactly like the early bar or the late bar. But that was deceptive, because all you're doing from the first bar to the second bar is changing, you're throwing off the beginning bar and adding one more, and that sequence that I was coming up with would never turn the trade around. So I thought, yeah, I have something that is going to give you up to 3 trades a day, but it never did. It was only after extensive look back in the show me studies that I realized that I have a system that does 2 trades a day max, not 3. So it's kind of interesting in that how you have to be careful, even when you're a seasoned trader in your research. It's very easy to be fooled. All right, so you're holding your 8:30 trade, and whether you continue to hold it or reverse it depends on this set of signals. You want to reverse and go long or stay long, whatever the case is, if you have, again, minus, minus, minus. Now, at 1 o'clock, the 3 bars you're referencing are the first 2 bars of today and yesterday's last bar. Okay, you're at 1 o'clock. You look at the open to close of yesterday's 1 o'clock to 3:15 bar, and then today's 8:30 to 10:45, and the 10:45 to where you're at 1 o'clock. And from furthest back to most recent, these are your buy signals: minus, 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 plus, 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 minus, minus, plus, minus. Again, mirror image flip around, get short at 1 o'clock or stay short at 1 o'clock, following plus, 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 plus minus minus, minus minus plus, plus minus plus. All right, so again, this is a rough concept. If you're interested, run with it. If you find anything great, let me know. Trades have different overall characteristics depending on the time of the day. Breaking days into three equal parts and using the three prior bars as a signal has a simple symmetry that is paid off over time. You've seen that. And the reason I like this more than anything is because it's unique. I don't imagine there's going to be a lot of people trading on 135-minute bars. Okay. Don't forget to check me out at artcollinstrading.com. Email me at art@artcollinstrading.com. I answer every email, and I appreciate you joining me.